My name is Femi Oladehin. I'm a chartered accountant and investment banker. I will be taking the class on finance for small businesses. This is Dang Masterclass. The first thing I always tell small business owners, and the first thing you probably need to remember every time of your business is profit is not the same thing as cash. And you must understand that once a business runs out of cash, the business is dead. Cash is the finance, is the blood that is in a human being for a business. So I would always equate cash and blood as the same thing. So for a small business, you must never run out of cash. Don't confuse profitability with positive cash flows. So cash is king. I mean, cash is not just king. Cash is king, queen, prince, and princess. In fact, there's empirical evidence that 90% of businesses, of new businesses, would either die within the first 3 years. And the reason why that happens is always because the business runs out of cash. Businesses never die, just because the economic environment has changed or the business owners have made bad decisions. Businesses die when they cannot meet their obligations. And you can only meet your obligations if you've got cash in the bank. A lot of people go into a business, and in Nigeria in particular, there's the herd mentality where there was a time when pure water business was the right thing, was the new wave, and literally everyone wanted to own a pure water business. The reality is that for you to start up a business, a couple of things are very important. Are you creating a service, or are you offering a service that everyone is going to need? And if people are going to need that service, are they going to need it for a long time? And because you shouldn't build a business to basically attack a short-term opportunity. Like there's a World Cup coming now, or we're in the middle of a World Cup, and you build a business just to target the World Cup. What happens after the World Cup? So that's number one. Number two is you must always ensure that the business that you're going into is one where people are willing to pay for the services that you're offering. And they're willing to pay not because they're doing you a favor, but because you're providing or you're meeting a need. That's extremely important, because if you don't meet a need, then the early periods, people might do it just because they like you, but thereafter, everyone will move on with their business. The third thing that I would always say is that you always have to focus on your costs as a small business. Usually, you're very aggressive when you start up, trying to attract new customers and giving them all sorts of promotions and all of that. The tendency is that if you keep that attitude towards running your business of always providing promotions, you're most likely going to run into a challenge in a very short period of time, because when people get used to a particular type of relationship with you, they expect that relationship to continue. So a situation whereby you've been selling on credit for 6 months or for 9 months, and then you suddenly change, you would imagine that people would have resistance to that. So as much as possible, provide people with the service and costs that you're going to use on a go-forward basis so that you don't run into problems. Your budget is basically a document that you put together as an entrepreneur that is focused or targeted at you taking a view of the future of the business. So your budget can either be for a 3-month period, for a 6-month period, or for a 12-month period. Some people even have 3-year rolling budgets. But what your budget basically says is you have forecasts on how much revenues you want to generate or you expect to generate based on your reading of the market, based on where you think the economy is. And then you also have a budget for your costs, which says how much do I expect to pay my suppliers, how much do I expect to pay my staff, how much do I expect to pay to the government. And then you put all of that together. So you can either have a cash flow budget, which targets your cash flows, or you can have a general full budget, which is actually including your profit and loss accounts and your balance sheet. Basically, you're saying in 5 years, this is where I want to be, and you're projecting towards that. For forecasts are more or less the same thing, but forecasts are probably wider because when you're looking at forecasts, you're focused now on on the generality of the environment. So you're forecasting inflation because inflation might have an impact on your business. You're forecasting the exchange rate. If you're somebody that imports hair, for example, from Dubai, if the exchange rate moves, how does that impact your business? You need to be able to think about that. You're forecasting the behavior of people. You know, if behavior, I mean, I keep, if you, one of the things that always makes me laugh is, you know, if you look at in the last 5 years, the way TV consumption, for example, has changed dramatically. That people are moving from watching terrestrial TV to mobile devices. Imagine if you had built your business just on on terrestrial devices, not thinking about the fact that there's a possibility that there's a change in attitude, there's a change in demography. All of those things come together in your forecasting. Your forecast would obviously feed into your budget.
That 5 minutes madness only you can understand. Visit myspector.com to get your Spector experience. Spector, loans in 5 minutes.
How does financing feed into your forecasting and your budget? And this is the way it works. When you create your budget, obviously, one of the things that will come out from a good budgeting process is the financing that you require for that business on a go-forward basis. Think about it. If you are starting a business for supplying children's clothes, whilst you are forecasting, you need to actually focus on how much capital you need to have in the business to be able to fund that business plan or be able to fund that budget. And that is where your financial structure becomes very important. Are you going to go and get money from a bank? Are you going to approach a microfinance bank? Are you going to approach friends and family? You must be sure that you have a source of financing to fund whatever it is that's going to generate the numbers in your budget. The challenge with businesses and being able to identify the pricing that is required for your business is a decision that an entrepreneur has to make. And you must find a balance. The balance you need to find is between making excess profits that's unsustainable or making a sustainable level of profitability that keeps you in business for over the long term. The biggest challenge most people have, and I think it's a cultural thing, is that when there's an opportunity, we want to maximize it and derive maximum value from it. However, there is a risk with deriving maximum value, except you are selling a product as a monopoly. The reality is that the market will always find its natural levels. So if you are bringing in children's clothes from Dubai and you are able to make 100% margins today, the herd mentality in the market is that in another 3 to 6 months, a lot more people are going to be doing that business because they will have found out that you are making excess profits. So what would happen is naturally, the prices of that commodity will fall. Now, the challenge is if you have already built your lifestyle or you've already started to fund your lifestyle using that excess profit as a normal, from an economic point of view, we know you're going to run into trouble. So what economists will tell you is that in the long term, your excess profit is always equal to zero because the market will always find an equilibrium. So from an entrepreneur's point of view, you can't afford to be greedy. You must always take a long-term view as to where your business is going and as to how you want to position yourself. Let me give you an interesting example. There are businesses that focus on a low-cost approach to delivering service. So whilst every other person in the market is selling a bottle of Coca-Cola for 200 naira, Some businesses decide they're just going to sell at 150 and they're going to focus on volume. The more bottles they can sell, the quicker they can turn their stock around. Some people decide, well, I'm a premium brand, I'm going to sell my Coca-Cola at 500 naira. The reality is that eventually, the person who is able to keep customers coming back is the person that succeeds. For a small business owner, what I generally say to people is when you start your business, have a small exercise book. Divide it into two sections. One section every month, write out your incomes. The other section every month, write out your expenses. Total it at the end of the month and decide, and you'll be able to see whether you're making money or you're losing money. So that's as simplistic for people that are starting out in business. However, if your business involves multiple customers and multiple return customers, you may want to take this a notch higher. Because if you don't have records of who's buying from you, the tendency is you may struggle with maintaining those relationships. If you're not recording, Mr. X is my biggest buyer. He buys between June and July. You need data to be able to forecast for your business, to be able to project as to where the business is going to. So for a small business, I would say you must at least be able to keep what in accounting they call single entry, which is have bank statements at the minimum, make sure that every revenue that you make goes to the bank. Even if someone pays you in cash, you pay that money into the bank. Yes, there's some cost to maintaining a banking relationship, but what it does is two things. It gives your bank a good idea of the business that you're doing. On the day when you need a loan from that bank, when they see the inflows and the outflows, they can decide maybe this is somebody we can afford to offer an overdraft. Second thing that happens is when you have that information, an accountant can build a financial statement for you if you are recording your transactions. So focus on ensuring that every single financial transaction you do has a record, either a receipt that you're filing away or receipts that you're giving to customers who pay you for goods, or invoices that you issue to customers that are buying on credit. But you must always have your records and have the discipline to find an accountant that can come in maybe every month or every 3 months to do your numbers.